Hello guys, my name is Andrea Allred. I'm a CPA here in the Woodlands serving the greater Houston area. And today I want to talk to you from a CPA perspective on some very basic tax tricks that most of you may or may not be aware of, that your CPA may or may not have told you about. Just so you kind of get a feel for some of the loopholes, as I say, the legal loopholes, that is, that are still available to you, even as physicians. I think some of these will become common knowledge, and some of these will be ones you didn't really think about. At the end, of course, we'll have times for questions, and we'll disseminate my contact information after this. So let's go ahead and get started. Next slide. So the most common question that I get, and let me be clear, I'm not offering legal advice. I do work hand in hand with attorneys. In fact, they're right down the hall. And so I sit in on a lot of meetings, but I don't want it to be construed that I'm offering legal advice. But I do hear what they say over and over again. And so I know any attorney would say these same things, but definitely feel free to check with them. So with that being said, the most common question I get is, should it be an LLC? And so, and what I'm putting this in reference to is most of you guys may not be employees, but rather like independent contractors or I guess freelance physicians. And so generally the answer to that situation is, if you're something other than a W-2 employee, you should definitely be an LLC. And what does this provide? It provides protection against lawsuit from all of your other assets. And it also provides some tax advantages. So let's go talk about the protection for just a little bit. What I mean by that is, when you're in an LLC, everything within the LLC is subject to claims against itself, but not from outside creditors, so that if somebody were to sue you or whatnot, that they would be able to come after the assets within the LLC, but not necessarily the assets outside of that. I do have a lot of physician clients, and one thing that I do have learned with physicians clients is, if you are in a practice where you are billing, Medicare or any of the other major insurance providers, something that you do want to be aware of is that forming an LLC after you have contracts in place will cause you to have to renegotiate the contract, because, as you know, each contract is EIN specific. But hopefully for a lot of you guys, this doesn't apply because you are contract through a hospital or a major medical provider. And so they're paying you directly through your LLC, and not necessarily, you're not going after a health insurance company you're not billing a health insurance company directly. So with all that being said, I think absolutely you should be an LLC. The one thing common mistake I see is, after you form this LLC, is they are still cutting the checks to Dr. Smith. Well, they need to be cutting the checks to Dr. Smith LLC and not Dr. Smith directly, which may mean that you have to issue a new W-9. But after we had that all set up, why are we doing that, you ask me? Well, the reason that you're doing that is that, according to your mama, she said, oh, next slide, you should always be a corporation. And the answer is, absolutely, you should 100% be a corporation, but you should be an S corporation and not a C corporation. Now, let me explain the difference to you really quickly. So a C corporation is an entity that, yes, gets to pay the 21% corporate tax. But unless you're paying yourself a salary out of that, you pay the 21% corporate tax, and you pay then a 23.8% dividend tax. And so therefore, the effective rate of that is about 43.8%. So that's kind of almost a 50% tax bracket. If you're an S Corp, what happens for S corporation purposes is all of the income flows into the S corporation. And then you then pay yourself a reasonable salary. We'll get to that in just a minute as to what a reasonable salary is. And then the remaining comes out as distributions. And then you just pay your marginal tax rate, which can be anywhere for you guys somewhere between 24 and 37%. That being said, I do have some points that I want to talk about later on that will show you how you can keep below a $400,000 if you're married, or $200,000 adjusted gross income. And we'll talk about that, but keep in mind the real objective for anybody, especially my clients, is if possible, we can keep their income below $400,000. There's a lot of tax benefits associated, especially if you have children and with you being self-employed, because there's this concept called a qualified business deduction. And what the qualified business deduction is it allows you to basically get a 20% off your tax bill. And because you're a physician, as am I, an accountant, and attorneys and investment advisors, we're all under the kind of bucket. And the IRS says, we like you and we like what you do, but we're not what is trying to rebuild America. And so because we're in this specified services industry, that 20% QBI deduction, or qualified business income deduction, doesn't apply to you. And so what we really have to be aware of is keeping that income below that taxable income below $400,000, so that we do get that 20% QBI. And more important for me, because I have twin little boys, is I want my $2,000 per child tax credit, that $400,000 or that $4,000 break that I get for putting up with those little boys. All right, so let's talk about why an SCorp is advantage as I go off on that tangent. Next slide, please. So what is an SCorp? Like I said, an S corporation is an LLC that for federal tax purposes, you have elected to be an SCorp. So what does that really mean, right? You're like, Andrea, okay, you just said a lot of words and I'm not following you, right? So what that means is you set up your LLC, and that gives you the liability protection. A lot of people think, oh, I'm an SCorp, so I'm not an LLC. No, the LLC is how you are taxed, or what you are for state and federal purposes, but an SCorp is a tax election only. And so what you do is you form your LLC in your local state with the help of an attorney, and then for federal tax purposes, you file an 2553, which is the S election form, and you tell the IRS, hey, I know I'm an LLC, but I want to, for federal tax purposes, be taxed as an S corporation. And you're like, well, why would I do that? Well, here's why. Because otherwise, you are your LLC income, because it's solely owned by you, is subject to self-employment tax for every dollar you make. And you're like, okay, Andrea, what does that mean? Well, what that means is you pay 15.7% on your income up to $137,700, or the Social Security limit. And then on the difference, you pay 2.9% indefinitely. So what does that mean? That means if you make $1 million, you pay $29,000 in self-employment tax on top of the 37% tax that you pay on that. And think about it back to the days where you were an employee and you were getting a W-2, or maybe you are an employee getting a W-2. You have federal income tax withheld, which just pays your tax bill, but additional withholdings from your paychecks is your Social Security and Medicare. And so as an employee, you pay your half, but as the employer, there's another half pay that your company pays. Well, the beauty or the privilege that you get when you're self-employed is you get to pay both halves of that unemployment tax, which I said is now 7.65 for Social Security and 2.9 or 1.45 for Medicare, and both halves. So that means 15.7%, like I said, up to 137,000, and then 2.9% indefinitely. So let's look at my example right here. Let's say that our net income, and so what that means is the gross income that we've taken for our physician services. So the checks that the ER or whatnot has written you, or the independent practice has written you, maybe was 500,000, and we took your cell phone, your car, some other expenses, and we'll get into what is tax deductible there. But we've taken those, and so we get down to a net income of $400,000. So if you were not an SCorp, so you decided, hey, I like your spiel about the asset protection, talk to my attorney, he verified that an LLC definitely gives me the asset protection, but you don't make the S election, then you'll pay $21,619 on the first $137,000. and $7,607 on the 262,300. So what I did is I took 400 minus the 137,700. That gets you the 262. So your total self-employment tax is 29,226. That's a tax that you pay. That's not your income tax. That is just the self-employment tax. That's the privilege that you get to pay because you've chosen to become a self-employed individual. Then on top of that, let's say that your marginal rate is 24%. So your income tax is $92,000. So your total tax on the $400,000 of income is $121,719, or roughly 30%. So when you hear people talk about a 50% tax rate, the way that they're coming up with that is they're saying I'm paying 15.7% self-employment tax, and then I'm also paying a 37% individual rate. And so that comes up to roughly a 52% tax rate. So that's why people say half of your income goes to the government. So the way that we mitigate this is we file the 2553 and we become an S corporation. And by becoming an S corporation, the IRS says that as long as you pay yourself a reasonable salary, then you don't pay self-employment tax on all of your earnings. So hear me clearly that this is not a income tax play. You're still going to have to pay income tax. I get a lot of people confused about, what do you mean I have to pay tax on the money that the company made? Well, yeah, you have to pay income tax on all of your income. What we're doing is we're saving that self-employment tax, mostly the 2.9%, but to some degree, if you could justify that you're maybe a new physician or a younger physician and your salary could be less than $137,000, then there is some of that to be saved. But otherwise, you're going to find that you can be an S corporation, and back to if you pay yourself a reasonable salary, then the rest of your earnings are just taxed at your marginal rate. And so let's hit on that reasonable salary. So what the reasonable salary is not what your gross amount agreed upon or your negotiated contract rate is with the organization for which you're contracting. What the reasonable salary is if you were to work for somebody else and not be self-employed, what would they pay you if you were a cost center? So for most emergency room physicians, I found that that's about $250,000. For a mid-range, not high-end hospital, whatnot, or high-end provider, I would say for a mid-range that the salary is going to be about $250,000. So if we take the position that your salary is going to be $250,000. So under the S Corp scenario, your salary is $250,000. The tax on that $250,000, your SC tax is $24,600, and your income tax is $93,048. So your total tax is $117,468, a difference of $4,071. So just by making the S election. Now, hear me clearly. It's not because you decided to become an LLC. You have to go to the level of the S Corp. But just by making the S election, you have saved yourself $4,000 in taxes. So it's not all butterflies and roses. There are some, I would say, additional steps. So now you're filing 2 tax returns. Normally, if you were a Schedule C, you would just have your LLC reported on your individual return. Now you have to file a separate tax return, and you have to file payroll reports. I've generally found with the payroll provider that I use for a single S Corp shareholder, they generally charge about $600. A common question I get here is, hey, can I put my wife on the payroll? Should I put my wife on the payroll? Or should I put my spouse on the payroll or significant other? And what I would say to that is, I mean, unless there's an overwhelming reason to save you any money in taxes, and in fact, you're actually paying double the self-employment, because if it's just you, then you're paying the self-employment tax on you. But if you add your spouse, this is one of those things where self-employment is taxpayer specific. And so you would be doubling up on the self-employment tax. Now, there are reasons to do so, such as if you wanted them to be able to put away money for retirement or have a defined benefit plan or other reasons. There are, but I just commonly find that clients come to me and say, hey, I want to put my spouse on the payroll and I want them to get a paycheck because then I'll get to write it off. It doesn't really work that way because you guys file a joint return. And so the income, whether it be wages or whether it be the net income from the SCorp, still flows to your individual return. And so therefore you are still paying tax on that money and you get the privilege of paying self-employment tax on that income. And so, like I said, in the rare situation where you want them to participate in the defined benefit plan or maybe have them put money over into a Roth IRA, that doesn't necessarily make a lot of sense. We will talk a little bit about the benefits of putting your children on the payroll. But I would say overall, I'm not hugely a fan of putting spouses or significant others on the payroll. All right, so next slide. So here are some other advantages of being an SCorp. So I work obviously with a lot of physicians' offices, including oral surgeons, dentists, emergency room physicians, and whatnot. And over my experience, these are some other advantages to think about, especially if you're a doctor's practice. So there's a bunch of you in the practice together that come with being an SCorp versus a C-Corp. Let's be clear. Obviously, you can tell from my tone, I'm not a fan of a C corporation. I've yet to see other than 1202 exclusions, which is where when you sell your practice in a stock purchase, you get to exclude 100% of the gain. But guess what? You as specified service providers, you don't qualify for that, just as I don't if I were to sell my practice. So I rarely find a situation where physicians are better off being C corporations. I know ages and decades ago, back in the 80s, when most of us were being born, it was advantageous. And I know a lot of practices got set up that way. But unless you're going to go take your company publicly and be a publicly traded company, sorry, the numbers don't lie, no matter what anybody says. Okay, so back to why do you want to be a S-Corp? So you can be an S-Corp. So being an S-Corp is easy on the M&A transactions, especially when some mergers and acquisitions. So when you go to sell your practice, a lot of times if you're a C corporation, you incur the double taxation. And what I mean by that is generally on the sale of a practice, most of the proceeds or the net income from that are going to be taxed at capital gains rate. But if you're a C corporation, you're going to pay the 21% tax on the sale of the assets, because that's generally what gets sold. And then when they distribute out the earnings to you, you're then going to pay a 23.8%, so about a 44% tax rate on the sale of your practice, versus if you were an S-Corp, that capital gain would be recognized at the S-Corp. And just like I've said before, the income from the S-Corp flows through to the individual shareholders and they pay tax at the shareholder level. So you would incur the one and it wouldn't be subject to the Medicare Obama premium tax. So it would just be a flat 20% or 15%, depending on where your taxable income came out. So other things to not put into an S-Corp. We don't want to put real estate into an S-Corp. I know some of you physicians may own the building that you operate out of, or, thinking about, it's like, I heard the CPA give this spiel about how fabulous S-Corps are. Well, S-Corps are great, again, for reducing self-employment tax. But are not taxed or not subject to self-employment tax, because that's considered passive or investment or portfolio income, not like sweat of the brow. So let me take a minute and kind of back up my thoughts so that you get what I'm saying. So there's what you call sweat of the brow, which is like me being a CPA providing my services, you as a physician providing your services, attorneys providing their services. Those are kind of all sweat of the brow, like compensation type, compensatory items. Those are subject to self-employment tax. Also, if you have an LLC, which you materially participate in, which we'll touch more on that in a little bit, though that too, if it's a trade or business, so if you have a manufacturing facility, would all be subject to self-employment tax absent an S election, right? But then you have things that's called portfolio or investment income. Rental income in and of itself, just statutorily written to not be subject to self-employment tax. Dividends, interest, capital gains are not subject to self-employment tax. So with this in mind, if the purpose of forming the SCorp is the self-employment tax play, you're not going to want to put those items into an SCorp because there's no benefit. Now, there may be an estate planning reason or there may be an asset protection reason to go ahead and put those into an LLC. Remember, things can be in an LLC and they don't necessarily have to be in an SCorp. So just kind of keep that in mind that, yes, you heard this great CPA tell you that you need to form an SCorp, but remember that that's for sweat of the brow income. That's not necessarily for investment income. All right, so we've talked about the SCorp. Next slide, please. We've talked about the SCorp. I think we beat that to death. I think you guys see how wonderful that is. But let's talk about things that I commonly see clients leaving on the table. So part of what I really love to do is the consulting piece of it. And a lot of it is legally maximizing tax deductions. So these are all items that, you know, if you are an SCorp or have any other kind of business that you probably didn't know you could deduct or commonly left off, such as your cell phone, right? Now, granted, if your employer is paying for your cell phone, you can't also run that through, or if you're being reimbursed, but your cell phone. Automobiles are a big, big one. I know people think it's cool to have that little 2-seat race car or whatever. Sorry, I have twin 5-year-old boys. So yeah, I have the Mama-mobile, not a minivan. And let me tell you why not a minivan. Not only are minivans not cool in my eyes, but minivans are not cool in the IRS's eyes. And let me tell you why. So the IRS has a rule that says if a vehicle's gross vehicle weight rating is more than 6,000 pounds, you get to automatically write off 100% of the vehicle in the tax year that it was acquired. Now, keep in mind that we have to make sure that this automobile is used primarily for business, which generally isn't hard because, as you know, you have the mommy mobiles and then you have the work cars, and we don't want goldfish, crackers, and all that kind of stuff in the work car. And so generally the position I take is we have a second vehicle, and that's where I take the kids to soccer practice, baseball, whatnot. So we don't write off that. But my bigger car, SUV, is what we write off. And so basically I make sure that I log my mileage. I use Mile IQ, and basically 95% of my vehicle is business use. And so let's say I pay $50,000 for it, 95% of it is deductible. I get a $47,500,000 write-off against all my other income. And that also includes repairs, maintenance, gas, insurance, all of that. And also keep in mind, a lot of people have the misconception that the automobile has to be in the name of the company. I would actually not recommend that. And there's two reasons. One, because in Texas, you have to pay personal property tax on any asset within a business. The IRS does not specifically say that the vehicle has to be in the name of the business, but rather it's the business use of the vehicle. So as long as you can prove the mileage, then you're good to go, and you can go ahead and write off the vehicle. And also for liability purposes, let's say you get in a car accident, run the little old lady over in the wheelchair, and they want to sue your company. Well, if the if the car was in the company name, that's an asset of the company. So it's a little bit different than I would say, you owning the car outright. So again, check with your attorney, but that's the general fact. So the vehicle doesn't have to be in the name of the company. In fact, I don't recommend it. And you still can expense as long as the gross vehicle weight rating is more than 6,000 pounds. You can Google and find common ones. There's a Mercedes that's over it. It's the bigger one. Jeep Grand Cherokee, the Lexus 460, the Tahoe, the Suburban. All of those have a gross vehicle weight rating of more than 6,000 pounds. And so therefore they qualify for immediate expensing. Some of you will ask me, well, what if I buy my Tesla? I think there's one Tesla that has a gross vehicle weight rating of more than 6,000 pounds. Otherwise, you're limited to $11,800 deduction for the vehicle. But you get that and you still get the credit. So if you want to go get the Tesla or any other electric vehicle, you still get the tax credit and you still get to write it off. So you kind of get a double dip. All right, I think I beat that horse to death. Let's talk about other deductions. So a defined benefit plan. So what is a defined benefit plan? A defined benefit plan allows you, while you're earning higher income, to put away significantly more money into a retirement plan. And you have to adopt it at least for 3 years. But you know, when you hear your fellow physicians say, hey man, I got to put $200,000 into my defined benefit plan and I got this huge tax write-off. And you're like, what? I thought the limit was 53,000 or, you know, 60,000 if you were old and had gray hair. Well, that's true. But there are some detriments that go along with it. Like I said, you have to have the plan in for 3 years or longer. There's some testing that goes on. You have to offer it for all of your employees. Again, if you're an SCorp with only you and or your spouse, then that's okay. But if you're a physician's practice and you have, you know, maybe a nurse practitioner or a couple of administrative assistants, probably a defined benefit plan isn't going to be for you, because you're gonna have to do whatever you do for you, you have to do for others. So the one thing that I want to bring up here too, while I'm talking about that, is that's going to go across the board. So as a physician, if you're invested in other businesses and you own more than 50% of any other businesses, whether it's a 401k, defined benefit plan, SEP, simple, whatever, any business for which you have more than 50% ownership, whatever retirement plan you sponsor for you, you're going to have to sponsor for all the companies and all the employees across the board. So just kind of keep that in mind and definitely consult a CPA and a benefits plan advisor when you start to go do these things. Don't go say, oh, I heard a CPA say da 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 da. There's always rules, there's always traps, and so you just have to make sure that you're going by the book. All right. So another thing that is much easier is a solo 401k or 401k. The limits there are between deferrals and match. The max that you can put away is $53,000 per person. And so what I really like about solo 401ks is I like the fact that if you set it up correctly, you're able to do a Roth contribution and you're also able to do a traditional contribution. Let me just throw this in real quick, but you're going to want to get with a financial advisor. You want to make sure that you're properly allocating your assets so that you're not taking the huge tax write-off now and maybe leaving money on the table later or paying a higher rate. Let me give you an example. So back to this defined benefit plan. Let's say that you put, you know, $200,000 away for the next 10 years. So without growth, you put away $2 million. And let's say we were able to get your income down. So you were at 24%. You're like, man, I did a good thing. But here's the thing. Tax rates are lower than they're ever going to be right now. And so what's going to happen is you're going to basically have to take that money out when you're in your 70s. Tax rates are going to be higher, and maybe you paid yourself 35% on the earnings, and when you only got to write it off at 24%, so, or 35% on the total distribution. So have you really done yourself any favors? Not 100% sold on that. So that's what I like about using the Roth vehicle, is at least you're putting some money into a Roth, which will grow tax-free. And then you can later in life, when that goes out, so that you're able to manage your income, because the worst thing you want to do is have higher income in your 70s and 80s than the income that you had while you were working professionally. All right, so other things, home office. That's a huge one that I see left on the table, especially with you contract physicians or physicians who work all over. Obviously, home office, you have to make sure that it's exclusively used for that. I think with COVID, the IRS is going to give a little bit of exception because now we've got our kiddos and everybody in our home office. But basically, it's a way to write off about 10% of your cost of living and your house costs every year is what I find is, anywhere between 7 to 10% is what the office occupies. So you can write that off. Children on the payroll. So this is one of my favorite ones. So as I told you, I have twin 5-year-olds. We live on some acreage, and when I have clients come over, one of my boys, if they're not in school, goes and opens the gate. The other one loves to shred. Not sure his obsession with shredding, but he loves to shred. So I will pay my kids each $6,000 this year. And what that does is, you can have income of up to $12,000 because that's a standard deduction now without really paying tax on it. Yes, I will have to pay payroll taxes on it, but it's shifting it from mine and my husband's income tax bracket, and it's also reducing our income tax bracket down to the kids. Now, I wouldn't put your 1 or 2-year-old on the payroll. I think 3 is a little aggressive. 4 or 5, okay, maybe. I wouldn't go paying them tens of thousands of dollars. But let's talk about those of you that have teenagers or older children or children in college. It's kind of a way that you can legitimately write off their college expenses because you have them come home for the summer and you pay them to work around the office or to help you with bookkeeping or whatever it is you need. You put them on the payroll and then you get to deduct that. And so that's $12,000 that moves from a high tax bracket to being non-taxable. And then they can use that money to pay for college or, gas or food or parties or whatever. And basically you've been able to write that off. So just kind of think about that. I think that's one of those that you've just got to make sure it's reasonable. Again, don't pay your 2-year-old $24,000. All right, so the other thing that changed with the Tax Cut and Jobs Act is the limitation of charitable deduction. So one thing that I do for my boys' school is every time they ask for money or whatnot, I categorize it as advertising or sponsorship. So when they go out and they say, hey, the PTO needs money, I'm like, send me a sponsorship form. So what is sponsorship? So sponsorship is basically where you have your name, logo, slogan, you get some kind of benefit out of putting your name out there. And so everything I do is advertising because, as you know, there's a very high standard deduction. Charity is limited to 60% of your adjusted gross income. And most of my clients nowadays, with the $24,000 standard deduction, don't have enough to otherwise itemize. And the difference between sponsorship and charity is charity, you're deemed to get nothing in return. And so if you flip it and say, hey, I got some advertising out of this or name recognition or whatnot, then you get to write it off against your ordinary business income. And so that can be a huge tax savings because you're basically getting to write off your charity. And in fact, the IRS came out and said after these new limits were pronounced, is like, hey, don't forget about sponsorship. That's something we've had on the table forever. Okay, so the other thing that we're probably leaving on the table, like you're not thinking about, is business, meals, and travel. So when you're going out of town to do these seminars, which nobody's doing that right now, but let's pretend pre-COVID, we were all going out, we were traveling, whatnot. Those can all be deducted. The other thing that I allow, which might be a little aggressive, is what I would call recreational, or I would even more importantly call it board meeting. And so you get one trip a year, not extravagantly. Generally, I let them deduct the travel and the hotel. And that's where you have your annual board meeting and you get away from the kids and everything that's going on, and you really strategize as to where the company's going and what are your ambitions. So some years my husband and I have actually taken this year. I think the back porch and a bottle of wine is where we're going to have our board meetings. But think about it in that framework and make sure that you have minutes and you have things to document. Not just your trip to Fiji was you and your significant other getting away, but was it, you know, what did you talk about? What were the plans? What came out of it? What business purpose was it? And you get one a year. Not every trip can be written off. All right, so next slide. So this, as I promised, these are the last jewels left in the tax code. So there are two jewels I would deem, and I always steer my clients towards if they're interested. Again, don't let the tax tail wag the dog. But farming and real estate are the two last jewels left in the tax code. And what I mean by that is real estate, if you're a real estate professional, and so you're like, how do I get that? So more than half of your total services must be from real estate activity, and you must spend at least $750. So those of you physicians who are lucky to see patients half the time, maybe do surgery sometimes, but have quite a bit of free time, this may be an opportunity where you can either yourself designate yourself as a real estate professional, which I would recommend going to get your real estate license. $2,500 kind of closes the IRS's call that it's not truly business, or your significant other. A lot of times when we have a husband and a wife, or two spouses, the other spouse will become a real estate professional because they're otherwise house manager and responsible for the housing duties. And so we can definitely argue that they manage the real estate. And so what does this real estate professional mean? Real estate professional means that you have a handful of rental properties, or maybe you also have a couple of commercial properties, you know, that you've got a substantial investment. People come to me like, I have one rental house. I'm sorry. No, one rental house doesn't work. You have to have several rental houses. And the beauty is it allows you to transition some of those other regularly incurred expenses to business expenses. And as you know, real estate, you can do things such as get a cost segregation study, or they just inherently lose money because of depreciation. And so you're able to offset some of your physician income with your real estate losses. And so therefore, back to what I was saying before, that's how we legitimately keep your income below $400,000. Another one that I really, really like is farming activities. You know, me growing up in Texas, small town, and even now that I'm closer to Houston, I'm very passionate about farming. And so I will tell you myself, we throw off quite a large farming loss every year. And so for the farm, obviously you've got to purchase a farm, have some land, or rent some land. And then things like the tractors that you bought, all the equipment that you buy, and all of that can help offset some of your physician income. Now, what I will tell you is you have to spend significant amount of time. It's not one of these things where, oh, I went and hired a hand. And that's how we met the test. It can't be a hobby. You've got to show, as I tell clients, you've got to show a profit motive. The IRS can never fault you because you are bad at running a business, but they can fault you for saying what you're doing is not a business. And so what does that look like? It could be things like a business plan, you know, that the appreciation of the land is part of how you're going to make your money back, and all of these things. That being said, just remember that when you buy the land is not depreciable, but the barns and fences and all that kind of items are. Farms run correctly can throw off pretty significant losses. It's just the documentation to make sure that you're showing the losses. And like I said, the other mistake I see with the farming activities is people not documenting, or not having several years of no income. You need to have some kind of revenue stream. I think the real estate in and of itself is pretty self-explanatory, because obviously you've got monthly rental coming in or annual rental coming in. The farm is one of those that the IRS may tend to go after, but I think if the facts and circumstances are correct, you're fine there. And so next slide, the last thing I want to talk to you about really quickly for some of you to think about is asset protection and wealth transfer. Keep in mind right now that the current exemption is about $22 million or 11.5 per person. If Biden gets elected, he's already come out and he said that the exemption will go down to $3.5 million per person, and portability may go away. Well, what does portability mean? It means that when the first spouse dies, you transfer everything to the second spouse. And then when that second spouse dies, you get the exemption between the two. If portability is taken away, that means this spouse has 3.5 and this spouse has 3.5, and you can't combine it to 7. So just kind of be aware of that, especially after the election, that if Biden does get elected, that you know, some of you who thought, oh, 22 million, I don't need to do any estate planning. 7 million, especially if you're younger in your career and you already have a couple million in the bank and you're thinking, oh, no worries. Yeah, don't forget the value of compounding. And then I'll touch real quickly on asset protection. I really like family limited partnerships or family LLCs working with an estate planning, because it allows you to transfer assets to your kids in trust or outright and whatnot, and then you get a discount on the value of those assets. And more importantly, just like you guys, we're in fields that tend to be litigated, and so all of my non-exempt assets, which means anything other than my house, one vehicle, and I think $50,000 worth of personal assets, again, check with your attorney, are exempt. And so, you know, let's say you have a large investment account, or back to the real estate example. If you're holding real estate, that real estate should probably be in an LLC or a series LLC, so that you have protection of those against the acts that you perform as your medical practice, so that if a patient comes and sues you, those assets are protected. The LLCs and the LPs are really good avenues for protecting assets and wealth transfer. But just keep in mind, I think so many people are so quick to go to LLCs. In Texas, you can have gross income of $1,030,000 before you have to pay franchise tax. But once your income is over $1,030,000, you are then having to pay franchise tax. So what I see people doing is, you know, sticking investments or whatnot and realizing this huge gain on this sell or huge dividend or whatnot, and all of a sudden dividends and interest, which if in a limited partnership wouldn't be subject to franchise tax, are subject to franchise tax. No, I'm getting a little bit in the weeds, but just kind of keep that in the back of your mind in the event that you're having the conversation with your lawyer about estate planning, that, hey, I remember the CPA said something about franchise tax, so at least it starts the conversation. So with that, I think I've gone over my allotted time, so I really appreciate you listening to this very not so sexy talk about taxes. And at this point, if anybody has any questions, let me know.